everyone, welcome to The Explainer. Today we're going to demystify two financial tools that are basically like special discount coupons for a company's stock. We're talking about rights and warrants. They sound super similar, right? But they're actually used for very different reasons. So, let's just start with a really simple idea here. What if a company wanted to, reward its loyal shareholders, or maybe entice some new investors to come on board? Well, one way they could do that is to offer a special, exclusive deal, a chance to buy their shares for less than what they're going for on the open market. Okay, so here's what's interesting. Both rights and warrants, they've got some of the same DNA as call options. They all give you the right, but hey, not the obligation to buy stock at a set price. But, and this is the big but, here's the key difference. Options are usually created between investors, right? These things, rights and warrants, are issued directly by the company. Why? Usually because they want to raise some cash. So how can you tell them apart? Well, the biggest and most immediate difference is just time. You just got to look at the clock because their lifespans are worlds apart. Think of it like this. Rides are a total sprint. They're here for a good time, not a long time, and they're gone in just 4 to 6 weeks. Warrants, though, they're a marathon. They hang around for years. We're talking typically 3, 4, even 5 years. All right, so let's dive deep into rights first. The number one thing you got to remember about these is that they're a privilege, a special perk just for the company's existing loyal shareholders. It's a little something for the people who are already on the team. So let's say you already own stock in a company. Out of the blue, they might just give you these rights for free. It's basically their way of saying, hey, thanks for being an owner. They're giving you the first shot at buying new shares, usually at a pretty sweet discount, so you can keep your ownership stake right where it is. This whole thing follows a really specific, predictable timeline. It all kicks off with the company's announcement. Then you've got this period where if you buy the stock, the rights come with it. After that, there's a cutoff date, and then boom, the stock and the rights start trading as two separate things, all the way up until those rights eventually expire and poof, they're gone. Okay, so if you're a shareholder and you get these rights, you've got a few moves you can make. 1, you can exercise them and buy those new shares at a discount. 2, you can sell the rights on the market to another investor. 3, you could even buy more rights if you wanted to. But here's the one thing you absolutely don't want to do. Nothing. Because remember, they have a ticking clock, and when it runs out, they're completely worthless. So you might be wondering, what's one of these rights actually worth? Well, its value is actually based on a pretty simple formula. It's all about the difference between the stock's current market price and that special discounted price they're offering you. Let's just walk through an example to make it super clear. All right, let's say this stock is currently trading out there on the market for $25 a share. That's our market price, or S in the formula. But with your rights, the company is offering you that special subscription price, let's call that X, for just $23 a share, a nice little discount. And here's the catch, or the condition really. The company says you need to hand in 5 of these rights, that's our N, to buy 1 new share at that cheaper price. Okay, now we just plug those numbers straight into the formula. So we take the market price, $25, and subtract the special subscription price, $23. Then we take that difference and divide it by the 5 rights you need. And voila, you get an intrinsic value of 40 cents for every single right. It's that built-in discount just spread out over the number of rights you need to use. Okay, now let's switch gears and talk about warrants. Because while they also give you the right to buy stock, their whole purpose is completely different. I want you to think of them less as a reward for loyalty and more like an incentive. Yeah, see, unlike rights, which are for the people already in the club, warrants are often bundled with other investments, like bonds or preferred stock, to lure in new investors. They're like the free dessert you get with your meal, a little bonus to make the whole deal more attractive. Exactly. And that's actually the term the industry uses, a sweetener. So if a company is issuing new bonds, for instance, they might tack on some warrants. This way, the person buying the bond gets the regular interest payments, and they get a long-term lottery ticket that could pay off big if the company's stock price takes off.
Okay, now we get to the really critical part about warrants. The thing that makes them so attractive to some investors is their incredible leverage. Because they're usually pretty cheap compared to the stock itself, a small move in the stock's price can cause a huge percentage swing in the warrant's price. And that amplifies everything, the gains and the losses. Just look at this tale of two investors. You've got Beatrice. She buys the stock for $15, and it climbs to 23. Hey, that's a solid 53% return. Not bad at all. But then there's Louis. He buys the warrant for just $4. When the stock hits that same $23, his warrant is suddenly worth $11. Do the math. That's a massive 175% return on his much smaller investment. That, my friends, is leverage in action.
And you absolutely have to understand this. Leverage is a double-edged sword. It cuts both ways. Let's say that same stock had gone the other direction, falling from 15 down to 10. The stock buyer, Beatrice, would be down 33%. That hurts. But the warrant holder, Louis, his small investment could get almost completely wiped out. We're talking a devastating 94% loss. Okay, so let's wrap this up with a final side-by-side comparison, just to make sure we've locked in the biggest differences between these two. All right, here it is in a nutshell. Rights, they're short-term, they're for existing shareholders, and their purpose is to raise money directly. Warrants, they're long-term, they're a sweetener for new investors, and their purpose is to make a totally different deal, like a bond, look more attractive. So what should you really take away from all this? First, both rights and warrants are tools companies use to raise money. Rights are a short-term thank you to existing shareholders, giving them a special offer. Warrants are that long-term sweetener to make other investments, like bonds, seem more appealing. And always remember, warrants offer powerful leverage. That means the potential for amazing gains and devastating losses. And that leaves us with one final big question. I mean, high leverage means high reward, but it also means high risk. That allure of 175% return is pretty powerful, isn't it? But so is the very real danger of a 94% loss. So you have to ask yourself, which of those suits your investing style? Because at the end of the day, understanding your own comfort with risk is the only way to know if something like a warrant should ever be part of your strategy.